Thank you very much for your time this morning, listening to me chat for, I think, 30 minutes. Very happy to make this two-way rather than me just like spurt for half an hour and go away. Happier to have a conversation, so please stop me at any point. I can dig into any topic you want to, dig a bit deeper. But the theme I'll talk about is change in the payments world, which is happening now at the foundation. So much of the fintech story to date has been about tweaking the top of the banking technology stack, so developing apps, new ways to pay with Apple phones, etc., new ways to lend, buy now, pay later. All that technology has been developed without really changing what's underneath. So essentially, we have the same old problem that we've been working on for decades or hundreds of years. So we'll talk about how that's changing and how we think, the people I work with and have worked with, that will have a massive impact to our world. And absolutely at the middle of that is blockchain, DeFi, and CeFi. So let's kick off. So this way. Okay. Basically, the way banking works today, with money tied up inside these commercial banks that control everything, problems and pain are generated that make it very difficult for companies to do well, hard for people to experience decent banking, decent support, and actually every now and then create major economic crises like, you're old enough to remember, 2008 and many others beforehand. Won't go into details, but there are many, many problems with today's world. Now, if it's bad today, it's going to get worse. So a couple of things are happening. So one, the adoption of banking by machines, so the Internet of Things. So by 2025, there'll be around 75 billion devices connected to the internet, which are working on their own, they're acting on their own, and they will be banking, they will be paying each other. There'll be concepts of, you heard of KYC? Yeah, KYC, know your customer. Well, this will be about KYT, know your thing. Okay, so there'll be players, there'll be many, many of them, and they'll also be working internationally. As well as that, the volume of digital payments is growing exponentially, and actually it's growing internationally. So again, to the point I'll make a bit later, and that I kind of open with, there's pain in the kind of foundation of banking that makes banking very difficult. That pain is much, much more acute when you start moving money cross-border. Within a country, the banking system hides the pain. So you can pay, if there's a Bob and Alice here, you can pay each other quickly. Barclays app to HSBC app, same country, looks fine. And that's because the banking system hides the problem, hides the difficulty from you. When you go cross-border, it becomes much, much more impactful. And these volumes are going to be very international. So people paying with crypto assets, people paying with commodities, people paying sterling, renminbi, dollar, etc. So the problems are getting more difficult. But the reason that the banking system, the payment system, isn't really up for what's coming, two reasons. One is that the banks we have today, the buildings around here, for example, are built on a model where thinking that the Medici brothers, that's an image of the Medici brothers in the 1500s in Italy. They would recognize that. So banks today, great big lending houses, they hold information centrally, they are the controllers of all the value you hold with them, and their primary purpose is to lend money, not to make payments. The payment exercise is something the banks would actually rather not do, but they have to because that's where the money system puts the job of making payments, which is why it's so painful. And actually, that model has persisted for many years, mainly because things our ancestors do resonate through time. And one of the big themes, I guess, you folks are looking at, or would be looking at, is how do you break these paradigms that have been there forever? So much of the blockchain world, much of the crypto industry, all the struggles and the media coverage, underneath it is a fundamental reality that this technology is shifting how we do things and forcing us to break some very, very old models that either people aren't thinking about or people are frightened to challenge. The reason I've got a space ship, a space shuttle, and a Mesopotamian chariot in this picture is because of the concept called the horse's bum, if you've heard that. Okay. The American space shuttle, when it was flying, the range of the space shuttle was limited because of the width of a horse's bum. And that's because the space shuttle had to be transported to the launch pad by train. And trains could only be so big because the size of the train had to fit the rail. Okay? The rails, when they were agreed, the width was agreed in the 1800s, was set to be about the same width as a cart that goes behind a horse. And the width of the cart was first set by the Mesopotamians around 4,000 or 5,000 BC to fit around the width of the horse's bum. So things that happened a long time ago resonate through history. And part of the challenge of really taking new tech and taking it from academia to actually working is to break those models. And the fintech evolution, or the fintech industry today, I would argue, has not yet broken the fundamental model of how money moves. And because of that, like the horse's bum, the space shuttle, we will be forever limited in what we can do unless we start breaking those models. So, I'm very excited about this decade because I think there are two tipping points that will happen which will change that paradigm. One is the idea of what we call a banking chassis. Okay, a banking chassis is breaking out what we see as a bank today and only keeping the tiny bit at the bottom that you need to hold and move money. And the second is a concept that I first heard when I met Chris Larsen at Ripple, which I fell instantly in love with, called the Internet of Value. The idea that money would move with the same speed and absence of friction as information moves today. So they're the two big things which will happen at some point, I believe, in this decade. If we look first at the idea of the banking chassis, so my first tipping point, really I'm talking about unbundling what we see in the banks today and only keeping the basic part of a bank that holds money, the central bank, so that with a currency, that money can be moved around by fintech providers and individuals. There's a bank I'll talk about in a second, which I work with, called ClearBank, which is the first example of this in the UK. So what it does, number one, is it is a classic pub with no beer. Okay, national pub with no beer. It is a bank that does not lend money. The ClearBank is a regulated bank. It's regulated by the Bank of England, by the PRA. It does not lend money. If you put money to ClearBank, put £1, £10 into ClearBank, that money goes directly to the Bank of England. It only deals in central bank money. And that means that the bank creates a service to any fintech, any innovation company, any lending company, any, you name it, any could be a football club offering cars to their fans, provides that service in a way that's totally safe, money won't move anywhere. Very, very simple. It's not trying to do anything else but hold the money and move the money. And I want to point later about CBDCs and stablecoins. If you have a bank that works in that way, that's the perfect way to backstop, to guarantee a stablecoin or a CBDC. The regulators had a real difficult time getting their heads around what we were doing at ClearBank. They love the security, they love the fact that ClearBank is actually more secure than the UK economy. Because even if the UK government actually has more risk to it, well, even more so these days, but probably risk than ClearBank because it's linked to the Bank of England. But again, that model we think will grow globally and create that base. Again, I'm talking fiat currencies here, but you could create a similar model for the cryptocurrency, a non-state linked token or asset. And that's when you start getting into the CFI idea of having an entity that is there to create better access to an asset. So in the UK, sterling, this creates that access to sterling without all of the overheads that would be there with the old banking system. But it could also apply to the non-nationally linked currencies like Ethereum, XRP, etc. And here's a picture of ClearBank. You can see here the bank sits between the clearing networks of the Bank of England, and then some people in this room I know are looking at starting up fintechs and have applied to join ClearBank as customers. And again, we provide that pure clearing service. These guys can then innovate and do great things. The other big thing that's happening at the same time is this Internet of Value. And here the idea is that, how familiar are people with SWIFT and how money moves today around the world? Anyone familiar with SWIFT? Good, good, good. Anyone not familiar? Thank you. Thank you very much. Most people would have put my hand up, but thank you. Good man. Probably a number of people in the room. Okay. Thank you. So SWIFT is a banker's company. It was created by the banks about 50 years ago. It was created because when, at the time, merchants, because people didn't move money across border there, you went to the holiday, you went to the bank and got your cash, and then you went to the holiday and hang on to the time French francs. You never paid money cross border. Government, large companies did. When they did, the banks couldn't physically move money around between country to country. So if this table represents the UK, all the pounds that we use only live in the UK. If that table represents the USA, the dollars live in the USA. And the banks actually enable money to move between those countries by literally writing letters to each other. Please move my money, how much will it cost, how much have I got, how's it going? And that process has been electronically-ified using SWIFT, but that's what's going on. So if every table here is a country, it's an island. The banks in that country move the money around, and when someone needs to change value or pay somebody in a different country, they have to send letters to each other. And that fundamental method is the reason why I think it's so hard and so expensive and so difficult for companies and people. The idea here is that we adopt an internet model and we join them all together, as you would do joining data centers today to move information over the internet. And that's where the Internet of Value comes from. There are a number of companies which are driving this model and bringing it to market. I've got a couple here on the slide that I'd really recommend you read up and have a look at, because interestingly, they're all using a combination of blockchain. Some are using digital assets, others are purely connected together. But the blockchain thesis, the idea of distributed finance, it plays perfectly to the need to interconnect countries. If you imagine each table being a country, how are you going to control that centrally? Who's in charge? No one's in charge of the world. The USA behaves like it is, but it's not really in charge. Okay, so the only way to solve that cross-border payment problem is to look at the world like a network of ledgers that need to be interconnected as you interconnect the internet. So Ripple, for example, my little lights going back and forth, Ripple does this in two ways. One is it's created a standard like IP, the IP standard behind the internet. It's called an ILP, Interledger Protocol. ILP standard, which means that we can connect together different islands of money, sterling, dollar, euro, Ethereum, and we can move value between them immediately. It also uses the native cryptocurrency XRP, which is designed for hyper-fast payment, which then means it can move value from, let's say, my UK table into the token, XRP, and then trade out again into the dollar with complete transparency and immediacy. That's Ripple's model. The other way of looking at this is the RTGS.global idea, which just says, well, look, if we just connect together the countries, and we also, to my point earlier, bring the central banks into the payment flow as well, because central bank money is highly respected and closely controlled, that means we can create this network between these tables in the room of country money without using a cryptocurrency, without using classic blockchain. And the interesting angle here is that there are two ideas converging on the same problem. Both of them remove that painful, swift messaging letter method that's used today. And both will create a much more integrated payment world. And the interesting element goes around to the choice between having a network which is driven by central banks and governments and countries, which is how the RTGS model works, and having one which is driven by independent innovators, independent tokens, floating money, non-national money, which is how the Ripple model works. So it's worth digging a little bit deeper into how those models. I'm happy to provide more detail than I could do in like 45 minutes about how the ideas develop into these models. But the takeaway is that this is happening, and it's going to fundamentally shift the way the foundations work for the payment world. And everything you do, everything you talk about today or this week around money and P2P, underneath it is this shift. This is what's happening. So we give you an idea about why it's so important. So if you go back, actually, if you were here in 1900, you probably see something like that. You see people manually offloading, unloading ships. The docks in London, it was the biggest dock in the world at one time, but manual, very inefficient. And then some guy, his name, in 1954, invented the idea of putting everything into a box. And what could be more underwhelming than thinking up an idea of putting all of the goods into boxes? However, that really simple move led to this, led to automation of trade and automation of shipping of goods of any form. An economist attributed around most of the 700-fold increase in global trade since 1900 today to that, or sort of since the 50s, I should say, to today, to that invention. So I put it there because underlying both the Ripple model and also the RTGS.global model of interconnecting is that standard. It's coming up with the standard, the protocol, which means that these different lines of money can be connected together. So that's how it's going on. It's not blockchain-y, it's not sexy, but it's required to unlock the potential of interacting together in a much more kind of open world than we have today. So I'll talk a little bit about this DeFi, CeFi question. And again, I've described how the foundations are changing. Okay, so the idea of a very simple money holding moving bank and interconnecting different islands of money together. On top of that, you have the question of how you give access to those networks to people. Do you let them connect directly and then they look after themselves, so the funds, the value are distributed and they manage themselves, or do you provide service layers to kind of concentrate, not quite back into the old world of banks, but giving some kind of control around accessing the assets which are underpinning the movement of money. And really, certainly in my current life with ClearBank, we're seeing an awful lot happening in, I think you call it the CeFi level. So there's an awful lot of new market sectors developing to make access to those assets much more straightforward for people and for companies. So I've got down here the example of stablecoins. So, ClearBank, we're looking into stablecoins because ClearBank is so such a safe model. We think we're ideal for a stablecoin or CBDC. And we're finding actually, there are by country, there are many, many different solutions for how those stablecoins will be brought to market and managed and developed. And there are also, you can see how there's a whole industry developing. There are layers of services where companies can innovate, can grow, can be successful, and that all of them making, together, making the task of holding a stable coin, selling it, receiving it, minting or destroying, linking it to a bank, making that easy. I think also, looking at the euro backed stablecoin again, slide here, this is from one of our working documents. It illustrates how many different players are involved in that kind of concentrating management work of those stablecoins. So if I were to kind of step back from that, so again, the current banking world, which really is what we use to make payments, ultimately, no matter if you're using Wise or PayPal or whatever, the old banking world is below that with SWIFT, not fit for purpose. The big banks are slow to move, they're lenders, they're not payment companies, and the network to make that payment happen is very old and can't take the volume. Tipping points are the creation of those simpler banks, which also unlock the stablecoin and CBDC, make that possible without getting into problems like Tether, for example. And the internet of value, which to my horse's bum analogy, is a new way of thinking about connecting money together that no one's thought of before. And whether that will be delivered by linking together protocols and digital assets, crypto, or whether it will be linked together by bringing in central banks and doing it as a direct connection, we'll see. But many organizations now attacking that problem. If you look at the, it's called the FSB, after the problems of 2008, the G20 kicked off a body called the Financial Stability Board. The great and the good, trying to make sure things never went wrong again. They've commissioned a lot of work with the Bank of International Settlement to see if they can solve this problem. So even the old guard, the governments are moving into that space, because if you can solve that problem, then to my first slide about this enormous growth in Internet of Things, cross-border payment, digital, you can support that. If we can't solve that problem, if things remain slow and difficult, then there'll be a point where digitization will stop. We won't be able to go faster because we're held back by the legacy. And in terms of my advice, our advice to companies and players in that market, it's good for the economy. It's good for what we're doing. It increases choice. It increases empowerment, creativity, but it comes with risk because the whole financial system is locked into the old way of working. And that, I think, is why you hear so much noise in the press about crypto problems, crypto winters. A lot of it's from the viewpoint that the old world works. Why change it? Which is a classic friction point against any innovation. So, thoughts to close. I would say embrace what's called creative disruption and ditch the incremental. So forget about the horse's bum, build a bigger rocket, do a SpaceX, go further. And also, it's a big world, isn't it? It's a big market. So as participants or academics or innovators, pick your spot, pick where you want to play, where you want to have value. So my focus is that cross-border. So I'm really into that cross-border connection, make it simpler, faster, give them that transformation, and get there early. So even though these new models are very nascent, Ripple transacts today. It moves money across border, lightning speed, on the blockchain, on XRP, RTGS.global. It runs today, moves money quickly. These things are happening, so I would not wait until everything's formed and all the fun is over. I get involved early. I think that's good.
All right.
Okay, thank you.
Excellent, thank you. So we have about 15 minutes for questions. So does anyone have any questions for Marcus? Well, I can start with one.
Okay.
So when you described so earlier you described how ClearBank works. You described the system that basically is able to issue additional money on top of deposits that it receives. So it's not really a bank, right? And when I think of banks economically, traditionally, I think it's an institution that takes deposits and makes investments.
Yeah.
So this one is doing the former, but not the latter. So what is it doing? It seems to be issuing some kinds of tokens or some kinds of assets in response for deposits. How is this different from a casino?
So the question is, how is this different to a casino? Very different, very different. It's very important to point out. So ClearBank is as far as you can get from a casino that is humanly possible. So the way the bank works, it takes deposits from its customers. It banks fintechs. So the customers of ClearBank are fintechs and neobanks. They're all companies that when they go to open an account at Barclays or HSBC, they get a really bad service because they're doing the same job as the bank. They go to the bank and say, hey, can I be a customer of you? I move money really efficiently for people and they love my app. The bank will think, wait a minute, yeah, fine, I can earn money from you, but you're going to take all of my customers away from my own app. Okay, they're conflicted. The ClearBank model is all we do, we hold your money at the central bank and we clear your money. We will never go after your customers. And that's worked really well. We have a net promoter score. Net promoter? It's a way of measuring how much people like what you're doing, basically. Our net promoter score is the same level as Apple. You must be thinking, hang on a minute. How can a bank be loved like Apple? The reason is the old saying, the land of the blind, the one-eyed man is king. The other banks give such a bad service because they're conflicted. Just by saying, we will bank you, support you, we will not interfere with your own customer work. That is a massive impact, and that's shown on the advocacy, they call it, the way that customers react to what we're doing. So money comes in, we hold the money for those customers. They're using it for paying their own customers. They're using it for opening accounts for their own customers. In all, we have about 13 million accounts on ClearBank, but for about 200 of our customers. So one customer of ClearBank is Tide. Have you heard of Tide? It's a small business website. You can get started, open up a company, go on Tide, get going. Does many things for you. It'll also, oh, there's my man. So that card, hold on, the card's been held up here. That's a Tide card, but actually it's a ClearBank card because the account that you open is on ClearBank. So Tide, so every small business that opens an account with Tide, it's on ClearBank because Tide is ClearBank's customer. So we say, hold the money, move the money, and the money is actually at the central bank. And then if 2008 happens again, the central bank is the only place you want to put your money. Nowhere else. And that's ClearBank.
Thank you, Andrea.
So if I understand properly, you don't use this money, basically. You don't invest, you don't lend this money.
So good question. We don't. Question: do we actually use the money placed with ClearBank? We don't. What we do, we hold it completely with the Bank of England. Our business model is to earn money on the transactions we are executing for our customers, the payment to chats for clearing, faster payments, the foreign exchange that we do on their behalf. We charge for that as well. And we charge a platform fee. There's a membership fee for the bank. We do earn some income from the base rate of the Bank of England, and we sometimes share that with our customer. But that's how we make our money. We don't place that. When you speak to treasurers or people that have to manage funds for corporations, they have a policy called SLY, S-L-Y. And that stands for secure, liquid, and yield. So if you're the treasurer of Shell and you're managing, I don't know, £20 billion, the first thing you care about is security. Is that money safe? Is it going to go and disappear? The second is, can I get it when I want it? So if my boss wants to go and buy a company tomorrow, which often happens, can I get the money? And the more money you're dealing with, the harder it is normally to get it back when you want it, because the old banks have lent it out. It's gone. And the third is yield. Can I make more from that money? And these treasurers care much more about it being secure and liquid, and can they make more from that money? Which is why the model that we have is so powerful. They place money with ClearBank, it's safe, it's solid, they can clear. And what we think will happen is that banks around the world will adopt that model. But it means, because it's so secure, linked into the Bank of England, it's perfect for stablecoin. It's perfect really for a CBDC, because you can offer a CBDC that then works with the commercial banks rather than the Bank of England having to do the whole thing themselves. It's also perfect to be connecting points between these items of money. Again, because it's not a lender, it's a holder of money. It's a different mindset. Sorry, please.
Andrea, did you have a follow-up?
Yes, but so this is very clear. But suppose that everybody banks with you. Who does lending?
So please say.
Suppose that you all the customers are with you, with the ClearBank. Who is going to do the mortgages and?
Good question. So if customers hold their money with ClearBank and we just hold money, who in the market would the lending? What I think will happen, you can see it kicking in now, is that other fintechs will pick up that work. Whereas when I was at HSBC, we did everything. We did everything under one house. Now you have ClearBank holding funds securely. You have Klarna lending. You have Alibaba, Alipay running analytics, so they can check credit and they can lend that credit. You have foreign exchange desks. You've replaced the old bank with specialized players that really do the job very, very well. And the fintech model that enables that to happen. to be part of that story.
So I think you're saying you're isolated payments from credit service provision. I think we have another question.
Yes, which is the difference with the electronic money institution?
So
Which is the difference of this business model with the electronic money institution, EMI?
understand. So an electronic money institution, EMI, that's a classification that enables a company to hold money for their customers. So most payment companies, like Transfer or Wise rather, are EMIs, but they can't lend that money. They can only hold that money. Whereas a bank can lend that money. So to be a bank, you have the ability.
No, okay, but with the model of stable coin, to use digital asset instead of electronic money.
What's the again?
I mean, electronic money institution issue electronic money, basically.
Yeah.
Not digital asset, not stable coin. But which is the difference if you doesn't use the money of the client and you custody it in the central bank like electronic money institution does?
Yeah. The difference is that to access the central bank money, you have to be a regulated bank. So when you get a banking license, the first thing you can do is lend. And to your point, we don't lend, okay? Whereas an EMI cannot lend, it just holds the money. But the second thing it gives a bank is the ability to participate in core clearing. So below movement of money in any country is a collection of banks that connect to the central bank, and they're allowed to clear and settle. So ClearBank can clear and settle because of that. When you look at the issuance of a digital coin, with an EMI, it's supported by a bank. There's got to be a bank behind the EMI. So that's why we bank a lot of EMIs, because we are a very friendly bank for them compared to the other banks, which are more conflicted. But the EMI will hold money with the bank, in this case, ClearBank. The EMI was a digital asset, let's say a stablecoin company. That's absolutely fine. By holding fiat with ClearBank, that fiat is ultra secure because it hasn't been lent. It hasn't gone anywhere.
So I think you're saying you can do both of those functions. You can do both the layer 2 function banks do and the layer 3 function that stablecoin issuers.
The real difference I can explain to you from my point of view. The real difference is that if you use an EMI institution, you have to use their app and their centralized transaction engine, you know. And with your solution, the people can add the digital asset in their wallet. And this is the big difference, I suppose.
Yes, it's put very well. It's the thing behind everything is opening up. Rather than keeping everything closed, I'm a bank, it must be all about me. It's opening it. So you create the asset, fantastic. We will KYC you, make sure you're doing things well. Then we'll support you with the central bank money, which means it's ultra secure.
Thank you for that. I think Martin had a question.
Thank you, Marcus, for the presentation. Very nice. I also really loved your example, the tables to explain Swift. I think I also used it for my students to explain, for example, correspondent banking. Okay. It's so complicated. I had 2 questions. My first question was banks in other jurisdictions, they run into hurdles with regulators if they want to start with a similar business model as yours, where you kind of store all deposits, where the entire asset side of the company essentially consists of central bank reserve. So I wonder if you could provide a little bit more color on how the regulatory approval process was.
Yeah.
And my second question is related to deposit insurance. So deposits with ClearBank, are they covered by deposit insurance, or are they not, because they're deemed so safe that it's unnecessary?
Okay, understand. So the first question about the regulatory work, it's hard. It's hard. So my horse's bum example is a perfect example of what we have to face today. So we need a banking license in a country to do what we do. To get a banking license, you have to go through a very long process you have to put in a lot of capital, sometimes hundreds of millions of pounds, equivalent in euros or a Brazilian real, wherever you're going in the world. And you have to be tightly controlled by the central bank. They are your boss, and you have to play that role. And outside the UK, most countries have designed their rules for old-fashioned banks. So they want us to keep extra money for the central bank in case we have a problem lending. So we don't lend. It's only the UK, the FSA here is very far-thinking and has created an environment whereby the model we have can grow quickly and be very, very impactful. And as we're now expanding around the world, as we expand, we're finding that the countries we go to, it's more difficult to do what we're doing. We still have huge value, but what we think we will do as we become more successful and we grow, we're profitable now, get the credit rating, is very quickly the rules will start changing so that, if you like, the horse's bum becomes wider. So the governments are changing and creating a category of bank, let's say called a ClearBank category. That's a really good point. So we're having to change the way the regulation works to allow digital companies to benefit from what we're doing. But we will, that will happen. And the other question, which is the other point to Joseph's point earlier on, I do you guys know that every government runs a deposit guarantee scheme of some kind, where if the bank falls over as a depositor money into the bank, the government guarantees an amount. In the UK, it's £85,000. If that bank is regulated and controlled by the central bank, we are. So one of the big value points we have is that the accounts that are held with ClearBank, so your account tied with ClearBank, that carries the UK government's guarantee, which is actually really powerful. So we've made Tide actually a really secure, powerful company for its customers because we're behind it. But that's why we have to go through a lot of pain and grief, because we need to be certified and controlled by the central bank, which means we can do that.